What's up, you guys? This is Andrew Krongold at Spinnaker Investment Group, and this is Data on Deck. Today, we're going to talk about why do we invest from the investor standpoint and from a company standpoint. So how do we even get stocks and bonds? Well, stocks and bonds are conduits for capital. It all starts when a company needs to raise financial capital. They have two main options. Stocks, where an investor gives the company money, and in return they get shares in that company, where they own a piece of the company. The other option are bonds, where the investor loans the company money instead, and the company pays a fixed interest rate over a fixed period of time to the investor. So let's talk about why you care about investing your money and giving these companies capital. Let's look at an example where you have 14 cents and what it buys you each of these 3 years. In the first year, 1918, 14 cents buys you a whole quart of milk. 50 years later, that 14 cents only buys you 2 cups of milk. By 2018, that 14 cents buys you a piddly 12 tablespoons of milk. So this means that we really don't have a choice but to invest our money. We don't want to keep it in a checking account or a savings account where inflation will erode your money because the price of everything else is continually going up. You have to have your money go up as well, which means you have to invest. So you might wonder, does investing actually keep up with the price of inflation? Had I invested that 14 cents, would it keep up with the price of the milk going up? Well, let's take a look at what a dollar invested over the past 90 years looked like. Let's take a look at this chart of monthly growth of wealth of only $1 invested from 1926 to 2018. $1, inflation takes that to $14 over the 90-year time period. Short-term treasury bills and long-term treasury bills, a decent amount over inflation, but the real return comes from $1 being invested in the large cap S&P 500 index that grew to over $7,000. So your $1 would be worth $7,000, where the price of goods, in theory, has gone up to $14. That's a huge return on your investment. And small cap companies, those smaller companies that grow into larger companies, $1 invested grew into $20,000, almost 3 times the amount of the S&P 500. The bottom line is we have to have our money invested, and over the long term, investors will be rewarded. Hopefully you guys found this educational. Thanks for watching. Don't forget to like and subscribe to our page. As always, if you have questions, shoot us an email or a message, and we'll be happy to get back to you. We look forward to you watching our next video. Thanks.